Hello traders, welcome to Ford Revolutionary Forex Institute. This is Kosnati, the founder and a senior trader of Ford Revolutionary Forex Institute. So traders, we are still continuing with the chart patterns. Okay, so in the first two videos I've discussed the reversal chart patterns. So now we are moving to the second category, which is the continuation chart pattern. So this video I will discuss with you, or I will teach you how to trade a wedge pattern. So a wedge pattern is actually falls under the category of the continuation chart pattern. So a chart pattern is the wedge pattern. So the wedge pattern is a continuation pattern. So as you can see here, we have the market going down, and then the market formed the wedge pattern, then went down, then the market is forming, and the market was forming another wedge pattern, and I was also expecting the market to go down again. So let's go. So there are two types of wedge patterns. So we have the first one is a rising wedge, and then the second one is the falling wedge. So I'm going to teach you how to trade the two. So let's start with the falling wedge. Okay, so the falling wedge, so the wedge pattern itself, it looks like a triangle pattern, but it's not sharp as a triangle pattern. Okay, so now the first category is the falling wedge. Okay, this is where the pattern, this pattern appears in a bullish trend. So the falling wedge, it has to appear in a bullish trend. Okay, so as I've indicated here, a bullish impulsive wave. So the market has to form the impulsive move. Okay, a bullish impulsive move. So the falling wedge will act as a correction pattern. Okay, so the falling wedge is actually the correction pattern. So in this case, so we have this impulsive move, okay, and then we have this wedge pattern. So this wedge pattern will be our correction for this move. So the formation of the wedge pattern, or of the falling wedge, is actually the correction move, or the correction pattern of the bullish impulsive move. So the markets will move higher in the uptrend and then form a correction. Okay, and then when it forms, so the markets will the falling wedge pattern will be the correction of the impulsive move. Okay, and thereafter, same thing applies as other patterns. We have to wait for the breakouts. Okay, so the wedge pattern is similar to a triangle pattern. So we have two parallel lines, okay, moving in a triangular pattern, and then as they are moving in a triangle, but the triangle is not that sharp. Okay, it's not sharp. So as it moving in a triangular pattern, some wedge pattern, they are formed by three legs. Okay, 1, 2, 3. But the most reliable wedge patterns are formed by 5 legs. Okay, so some of the time I label this as A, B, C, D, E. So if they are completed by 3, you will say A, B, C, then went up. So the main purpose of trading the falling wedge is to look for bullish opportunities. Okay, is to look for bullish opportunities. So now let me show. So you enter the trade once the market has formed. So once the market has broken the upper trend line of the wedge pattern. So we have this trend line going down, then this trend line going down. So you only execute. So we are only expecting the. So when the market is forming a falling wedge, we are expecting the market to break the wedge pattern on the upper level, on this level, okay, on this line, on the upper line. Okay, so you expect the market to break the wedge pattern in the upper line, and thereafter, some people, in terms of executing a bullish trade, some people will wait for the market. So some people will execute a trade immediately after the wedge pattern has been broken. Some people will wait for the breakouts. As you all know, traders, some people will wait for a pullback. As you all know, traders, I always recommend that you wait for the market after any breakouts. Wait for the market to form a pullback. Okay. Thereafter the pullback, you wait for any reversal candlestick pattern, and then you execute a trade. Okay. So in terms of executing, so now let's go to the live example so that you can see how to trade a wedge pattern. So now you can see that we have this. So we have a bullish trend. So the market was moving in a bullish trend, and then it formed a wave Y. So now the market completed this wave 2 in a wedge pattern. So you can see we have this wedge pattern. So now what you do is so I've done so in this setup. So I waited for the market to break. So the market broke the wedge pattern. So after the market broke the wedge pattern, the market started to consolidate. So after the market consolidated, I just executed a trade because I saw that this was the opportunity to execute a trade because the market has already executed a trade, and then now the market has broken the wedge pattern, and then now the falling wedge pattern, and then now the market was consolidating. So since the market was consolidating, therefore I should execute a trade to a bullish side. Okay, so in terms of putting your stop loss, when you execute a trade after the market, immediately after the market has broken the falling wedge, you have to put your stop loss below the last leg of the wedge pattern. So as you can see, this was the last point of the wedge pattern. So you should I place my stop loss below this last point of the wedge pattern. So if you execute a trade after the pullback, so you wait. So for instance here, let's say we waited for the pullback. We could have waited the price to form the pullback, then execute a trade here. So when we execute a trade here, we put our stop loss below the pullback. So this is simple. So that is how we trade a falling wedge pattern. So now let's go to a rising wedge. So we have a falling wedge, which so it has to be formed in a bullish market, and then so in terms of executing a trade in a falling wedge, we wait for the price to form a pullback. Then we put our stop loss below the pullback. However, if you execute it immediately, you have to put your stop loss below the last point of the wedge pattern, of the falling wedge pattern. So now going to the rising wedge. The rising wedge, traders, it has to be formed in a bearish market. Okay, the market will have to make a bearish impulsive move, as you can see here. Thereafter, after the bearish impulsive move, the market will form a rising wedge. A rising wedge is actually formed as a correction move. So since the wedge pattern will act as a correction move or the correction wave or correction pattern, so this is actually the correction pattern of this impulsive move. Okay, and therefore we saw, as I've indicated, that the wedge might be completed in 3 legs or in 5 legs. But I highly recommend that you trade a wedge pattern which has 5 legs, because the wedge pattern with 5 legs, it's more reliable compared to the wedge pattern with 3 legs. Okay, so now what you do, you wait for the price to break the lower line of the lower trend line of the rising wedge. You remember in the falling wedge, in the falling wedge, the market must broke to the upside. In terms of the rising wedge, the market must broke the wedge pattern to the downside. So what we do, we wait for the market to break to the downside, and then we also have to wait for the pullback. So let's go to the example just to show you what I mean. So for instance here, this is the falling wedge. I'm sorry, this is the bearish impulsive move. Okay, then the markets form this rising wedge. So after the formation of this rising wedge, the markets went down, break the wedge pattern to the downside, and then it's formed it's formed a pullback. So you can see that the pullback tested this downward line of the wedge pattern, and then the market tested this downward line of the wedge pattern with the shooting star. We call this the shooting star pattern. Okay, candlestick pattern. After the shooting star, you could have executed a trade, and then you can see that the wedge pattern went down. So in terms of the stop loss, if you execute it immediately after the breakout, put the stop loss above the last point of the wedge. However, if you executed after the pullback here, this is our pullback, you could have placed your stop loss above the shooting star pattern or above the pullback. So that is how we trade a rising wedge. So in terms of comparing the rising wedge and the falling wedge, it has to be formed in a bullish trend. Yeah, the falling wedge, it has to be formed in a bullish trend. Then the rising wedge, it has to be formed in a bearish market. So we only execute buy position, bullish position, long position in a falling wedge. We only executing sell position, short position, bearish positions on the rising wedge. Okay, because the rising wedge is formed in a bearish market, and then the falling wedge is formed in a bullish market. And then finally, guys, we need to understand that the wedge pattern itself, in general, the wedge patterns are actually the continuation pattern. It means that after the formation of the wedge pattern, the markets will continue to move it to its previous direction. So traders, that is all I have for the for the wedge pattern. Remember that we have a rising wedge and then we have a falling wedge. Falling wedge, buy position, rising wedge, sell position. Thank you guys for watching. I'm going to see you next time on the next video.